The next question for you is, that this is based on what I hear people tell me all the time, right? Are people still buying short-term rentals in this market, and how are they able to do that with a 10% down second home loan? So let's just go right into that.
Yeah, so we see a high interest rate environment and kind of think, oh, well, demand is going to go down. There's going to be plenty of opportunity now. We're going to be able to ask for what we want. And I just haven't seen a ton of that. Now, I will still call it a buyer's market. I really encourage people, if you're going to buy something, do it now before those people that are sitting on the bench get back into the game, because then you have to start giving things that you really don't want to give up.
Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review.
Thank you for joining us today. Today, I am super excited because we have Jeff again with us. Jeff has spoken to the community before. He is a seasoned loan officer at Northpointe Bank. He has 16 years of experience. We've had him, he helps out a lot of our community members as far as financing short-term rentals and other investment properties, but he loves educating. He's always the person we go to when we want to know if there are any changes that are made and if we're being compliant and what the rules are. And so we really appreciate everything you do for the community, Jeff. Awesome. I'm so glad to have you on here.
Yeah, it's a pleasure. Thanks for having me. Always great to be with you guys.
Absolutely. And so, I'm sure a lot of you have heard about us talk about how physicians are using short-term rentals to really shelter their clinical income from taxes and how they're able to do it with 10% down second home loans. And so we wanted to talk a little bit today about creative financing specifically related to short-term rentals. And I have a bunch of questions that I want to pick your brain about, Jeff, but we'll get started. Guys, as you're listening to this, if you have questions, make sure you drop them in the chat and we'll get to them towards the end. But Jeff, there's a lot happening as far as interest rates. And I thought maybe a good way to start would be to talk about what you are projecting in terms of interest rates going forward. We can start there and then we'll start deep diving into the STR financing realm.
You just wanted to jump into the deep end right off the bat.
Oh my God, yes. Well, that's the question everyone has, right? Okay, so what's happening?
Right.
How do we titrate? How are we strategizing around the changes that we're expecting?
Yeah, and I follow all the gurus in the industry. Very, very smart people that all they do for a living is they study everything that is associated with interest rates and what affects interest rates. And I heard one of these gurus the other day kind of summarize things in a very direct way, which is our jobs are really hard right now because there's just so much data that is going against mortgage rates, even though the feds are, cutting that prime rate, which if people don't know, that's going to be more associated with like credit cards, home equity loans, car loans, really anything that banks lend on outside of mortgages. And then, we really want to watch the 10-year treasury. We want to watch the unemployment numbers, the inflation numbers. So as inflation goes down, unemployment numbers go up, you'll typically see mortgage rates go down. So you're going to ask my best guess. I don't think they're going to go up anymore, even though they did go up about 0.25% after the feds cut the rate, which is odd, but it did happen. And so I think we've leveled off. We'll go on a downward trend from here until the end of next year. And so if you want to start where we are today, which is about 6.75%, and followed a downward trend to the end of the year to 6%. Next year, we're going to kind of slowly, stair step to that point, I believe, by the end of next year.
Yeah, and that's pretty much in line with what we've been hearing where we think it's going. And I've heard you say this before, Jeff, and I say this all the time. Even with interest rates where they are, people who are looking at short-term rentals, if you're buying the right property in the right market and you know what you're doing, people are still buying profitable properties. That interest rate hike did drop the cash on cash a bit, but it's not as big a jump as most people think, right? And so the next question for you is, and that this is based on what I hear people tell me all the time, right? Are people still buying short-term rentals in this market, and how are they able to do that with a 10% down second home loan? So let's just go right into that.
Yeah, so we see a high interest rate environment and kind of think, oh, well, demand is going to go down. There's going to be plenty of opportunity now. We're going to be able to ask for what we want. And I just haven't seen a ton of that. Now, I will still call it a buyer's market. I really encourage people, if you're going to buy something, do it now before, those people that are sitting on the bench get back into the game. Because, then you have to start giving things that you really don't want to give up, like option periods and waiving appraisals. And we typically have a short-term memory when it comes to that kind of stuff, and that's just a horrible environment. So
Yeah.
I'd rather be in an environment where you can go back and forth and do some negotiating, with the mindset that, hey, how can we make this a winnable situation for both sides of the party? So, okay, well, how about you pay 3% in seller concessions, and I'll not ask for 50,000 off the list price. So there's still some options out there like that, but yeah, still high demand. And the 10%.
Just to add on to that, Jeff, I know a lot of people feel like it isn't a buyer's market, but you're absolutely right. This is probably as good as we're going to get as far as a buyer's market, because as rates start dropping more, interest is going to go up, and transaction volumes being low has really locked us into this state where it feels like it's still a seller's market, but we are kind of at the bottom of the market and we're trending back up. So I'm sorry, I'm going to let you go back into what you were saying.
No, I completely agree. And so the 10% down second home occupancy loan is still alive and well, even though March of 2022, the feds came in and said, hey, investors that are buying these properties are bad people. We're going to impose these additional fees to deter them from using this 10% down product. And a lot of originators lost that opportunity because the fees did go so high with Fannie and Freddie, to the point where they couldn't pass a fees test. So you were hearing a lot of, that loan doesn't exist anymore, it went away. I'm here to tell you it's still here, and we've been doing it, since March of 2022 and well beyond, or well before that. So it is alive and well. It looks different day to day almost, where we're having to look at different loan structuring to get the best rates for our clients. So, we're always making sure that we're well in tune with just smart strategies on pricing and loan structuring, but there's still, very, very good opportunity from a loan product standpoint when it comes to the 10% down loan. And it doesn't have to be an adjustable rate. We've got some good options on fixed rates. So I know there's some credit unions that have good options, but my experience with my clients has been they get real nervous with that ARM product, just because you can't guarantee what's going to happen in 5 years, and you definitely don't want to be in a bad position. So people like that conservative approach with the fixed rate, and it's definitely there.
And I remember the time when you could get a 10% down second home loan, and interest rates for that product were very close to what you'd get for a primary residence. But then we saw that jump where it was closer to what you'd get for an investment property. But for a lot of people looking at short-term rentals, physicians included, if you can use leverage optimally, right, with 10% down, you can take less to the table. And, most often they also need to factor in furnishing. And so a 10% down is a very attractive option for a lot of people. So let's talk a little bit about that. How is that even possible, and what criteria does someone need to meet to be able to use that 10% down loan?
Yeah, and with some of this, I would love to have anyone chime in that they hear something different, because I absolutely love that opportunity to educate people on the correct policy. So I'm not going to say, no, you're wrong. Why would you say something like that? But I do like, when things are presented based on misinformation, because we've been doing this for a long time and we've had plenty of opportunities to vet our understanding of the policy with Fannie Mae and Freddie Mac directly. So it's not, we're just kind of assuming, we're taking our best guess on some things. We truly know the policy. And really what has set us apart from a lot of other lenders is we know the current policy. So I used to tell people, 4 or 5 years ago, when we, really got some traction in the space, there's about 90% of the or 10% of lenders that know the true policy, and there's only about 3% of us that have a correct understanding of it.
Absolutely. And we hear people all the time come back and say, but my lender says that this property is not going to qualify. And we're like, they don't understand the guidelines. And so, we're always referring them out to lenders who understand the product better.
Yeah. And I will say with that, most lenders, the majority of their business is helping people buy primary residences. So, it's like a physician that has a specialty that, a patient comes in and it's not in their wheelhouse, and they don't know what to do. So I'm not putting myself on the same level as a physician, but it matters. What matters, and what you do day in and day out matters. So that's where we've seen, our expertise come into with a lot of value for making deals work, like you said. But so just to cover some of the highlights, your intention has to be that you're going to occupy that property at some point during the year. So that's one of the big ones right there. Is a lot of people will say you've got to spend X amount of days or 6 months out of the year. There is no specific requirement. And the way I summarize it is, you just can't lose the ability to occupy that property when you want to. So you can't get into a long-term lease, of course. And that's why they're friendly towards like Airbnb, Vrbo, some of those OTAs, because they're not facilitating a legal lease agreement. And so if you wanted to go stay in the property, there was a guest booking, you have the right to cancel that as the owner if you chose to go occupy that property. So you don't lose control of the occupancy. There's no mileage requirement from your any real estate that you own. So another one is it's got to be 50 miles. There's no mileage requirement in place. If you want to do the second home occupancy loan, it really needs to be a 1-unit, single family, or townhomes. A lot of condos don't qualify for the program.
Correct.
With Fannie Mae and Freddie Mac. Yeah, and really, it's that straightforward if you know the correct policy. One thing that we've gained a better understanding on here recently is the ability to transfer title into an LLC, which I know with your group is huge.
Yes.
A huge issue. So the correct policy with Fannie and Freddie is you don't have to wait a year. You can transfer title right after you close.
Oh, Jeff, this is new, because I know last time we spoke, we talked about the 12-month wait period. And so
Right.
this is excellent. If you can just elaborate a little more on that.
Yeah. So we had kind of associated the transfer into the LLC along with the occupancy
Correct.
commitment of 1 year. And what we found out, and this is all within the past probably couple of months, is that that does apply with a primary residence, but anything like a second home, investment property, you do have to close in your individual name, but you can turn around the next day and transfer it into an LLC without the threat of the due on sale clause being executed. So I vetted that with probably
Excellent.
3 or 4 different sources, including Fannie Mae and Freddie Mac, just to make sure that I was giving out the correct information.
Perfect. For right there, you've busted a lot of myths. There's this assumption that there's a residence requirement where you have to stay in the property for 14 days. That is not true. That's not that's not a requirement. We talked about the 50 miles from your personal residence. It has to be 50 miles away from your personal residence. That also is a misinterpretation of the guidelines. And then I think one thing we didn't touch upon, but we've talked about this before, is you can have multiple 10% down loans even in the same market. You can have them across the country in different markets, but you can also have them in the same market. Correct, Jeff? So can you talk a bit about that?
Yeah, so you can have up to 10 mortgages in your name, and they could all have been originated as that 10% second home occupancy loan. And then as far as having or using that product in the same market, I coined this phrase years ago. It's not a policy, it's just something that I came up with, the idea of what it needs to look like, called the bigger and better rule. So, let's say that you have a place in the Smokies. It was 2 bedroom, 1 bath. Your family's really enjoyed going there, and you don't plan on going anywhere else, or you want to stay there. You want to keep that property, come back a year later and say, we love staying there, but we really need something that is bigger so we can bring, extended family. Everyone's more comfortable. We have, we're going to buy this place with an indoor pool. It fits this kind of idea that it's something bigger and better, and that would make sense to an underwriter. Accessibility case one time where I bought a property in the Smokies. They had knee surgery. And the first property was hard to get up to. So it was a real struggle to walk up to the house from where you parked your car. It made sense to the underwriter why we were going to use the 10% down second home occupancy loan to buy another property that was easy to get into. So it has to make sense. And we've done enough of these deals where we can have conversations with clients and say, yeah, that's great. I don't think we're going to have any problems. Or, yeah, you're going to have some problems with that one. So,
yeah, excellent. You touched upon a lot of interesting points. So 10 loans per individual. Now, for a couple, that can be up to 20 if they're not on the loans together, correct? As far as spouses go?
Yeah, that's correct. And that's where we get into a little bit of the gray area. Is, okay, my wife has this one in her name in the Smokies, and now the husband wants to buy one in the Smokies with the loan in his name. And kind of the rationale is, okay, are you going to go there and vacation and stay in separate homes? Probably not.
Right.
So that I would kind of steer people away from that scenario, just because I think it does get into some gray area where it looks like you're taking advantage of the loan product.
Correct. If it's in the same submarket, but if it's across the country, different markets, it's per individual. 10 loans is the limit as far as
correct.
The guideline.
Yep, that's correct.
And then the other question I get, and we talked about, you cannot have a long-term tenant. You can't establish a tenant-landlord relationship in those properties for the first 12 months of ownership. But I think a question we get from some people is they're looking at a second home loan product for an STR, but they don't own a primary residence. Now, does that affect their ability to get that second home loan product?
It does not. No, it does not. Yeah, as long as you have, an address where your mail goes, it's on your tax returns, you're renting that property, that would be considered your primary residence. You don't own it.
Yeah.
But that scenario wouldn't prohibit you from being able to use the 10% down second home occupancy loan.
Awesome. So I think we've really talked about the 10% down second home loan. I want to talk about another product that a lot of people thinking about STRs should be aware of. I know a lot of people don't use it, but there are some unique situations where it would make a lot of sense. So can we talk about DSCR and commercial loans and when someone would use those loan products to purchase a short-term rental, when it would actually make sense for them to consider those options?
Yeah. So, typically, and we're usually not talking to a client about doing a deal. We're usually building a relationship because they want to build a portfolio of these types of properties. And so we'll usually exhaust that 10% down second home occupancy loan for obvious reasons. And then, look to the DSCR loan to help them scale faster. So another thing to mention on the 10% down second home occupancy loan is you can't use the income from the property to help you qualify. Mm-hmm. So you have to be able to absorb that principal, interest, taxes, and insurance payment into your ratios without the consideration that property is going to be generating income. Also, you can use that income towards qualifying after you buy the property once that income has showed up on your tax returns for at least 1 year under Schedule E. So there could be a scenario where, let's say the first one you maxed out your ability to do the 10% down loan, and then 2 years later, after 2 years of income, because that first year may be a little bit light, and then that calculation for income gets stronger that second year. Now you've freed up a space to be able to do another 10% down. Well, you're going to have some people that say, I want to buy sooner than that. I don't want to wait for my debt to income ratio. So that's where that DSCR loan could come into play.
Hey guys, I'm here in Dallas. I'm touring the next acquisition, the townhomes at Bluebonnet Trails. This is in a Dallas submarket, Waxahachie, within a 30-minute commute to downtown Dallas. Dallas is seeing the strongest migration in the country. These are luxury townhome style units. You can see them in the background, and they have a very affluent tenant base. These were built in 2 phases between 2020 and 2021. This is a core asset, which means it's significantly lower risk. The rents are about $2,700 right now. But there is a gap, loss to lease, where we can bump up rents by another 2% easily. Occupancy is already super high at 96%. We're going to see longer, very stable, very affluent tenants in this property, which makes it low risk. We have a conservative debt structure, which is about 5.2% agency debt projected, 20% average annualized returns, and about 6 to 10% cash flow, which is typically what we see with deals that are, core assets.
The other group that comes into play for is for people that are self-employed. So, you write off everything that you possibly can that the law will allow on your taxes, and your tax return is not a true reflection of your actual income.
Yeah.
But that's what you have to use to qualify for a mortgage loan. So when I have a video on my website, and when I tell, I kind of use this phrase or this question, so you don't fit in the box. I get so many people's attention because they feel that that's me. I don't fit in that box.
We have a lot of physicians who are on 1099s, and then until they get to the point where they have a steady income for 2 years, they're not qualifying for, investment loans based on just because for the conventional mortgages, right? Because of the 1099. Right.
Yeah. So that product speaks to a lot of people in that space where they don't fit in that box because, and this is one of the big points of the DSCR loan, we're not using any personal income to qualify you for the product. So DSCR stands for Debt Service Coverage Ratio Loan. So we're looking to see if the debt can be serviced by the gross income that the proposed property is going to produce. Mm-hmm. So if you've got a mortgage payment that's $4,000 a month, if we can show data that will show gross income is going to be $4,000 a month, we're looking for a 1-to-1 ratio to get an approval for the loan. So
and that 1-to-1 ratio is based on its income as a short-term rental or as a long-term rental?
Well, it just depends on the data that can be provided. Now, we're typically doing these deals in destination areas. Mm-hmm. So it's very common that we can get short-term rental data, whether it's historical data from the seller or we are getting data from the appraiser. Yeah. And so if you've got an appraiser that's going into the Smokies or, one of these coastal towns where there's no long-term rentals, they only have access to short-term rental income data. Right. So we're able to get that. And then, we've been working with the same investor for 3 years. We know what they want. We know what they will allow, and they allow us to use Air DNA data to prove the ratio. So that's a nice thing in that we know we can use that data if we need it, if we can't get the first two. So if we've got a client that's looking at DSCR, we can, to get them pre-approved, we can look at market areas based on the property type that they're looking at. And then when they do find a property, we can run another Air DNA report. And because, again, we've been working with this investor so long, we can tell them up front whether or not it looks like it's going to be a viable deal. So 1-to-1 ratio, typically, I will say this. One thing that we've seen with the reins being loosened in the mortgage world, the biggest one has been around DSCR. So we're seeing deals where in fact, we closed 2 last month where the client only had to put 15% down, where typically the minimum down payment is 20%. So there's compensating factors on a deal like that. So we are typically well above the 1-to-1 ratio, really high credit score, a lot of reserves. So there's some, compensating factors that make for a strong file. So there is a chance for 15%. I almost hate to mention it because I like to deal in absolutes. But, typically we can tell a client when we're getting them pre-approved, we can look at their compensating factors up front and let them know, hey, this looks favorable that you could put the 15% down. I want you to be prepared to put down the 20%. Just in case, keep it in your back pocket, but we're really going to push for this 15% down. So 20% is the typical down payment for an experienced investor. If you're a new investor, that would be someone that has not owned a cash flow producing property for at least 12 months in the past 12 months, they would be required to put 25%. So we can do this loan on single family residences, multifamily, we can do it on condos. So there's more property types that you can do this loan with. Then you're going to need 6 months in reserves for the PITI payment, the principal, interest, taxes, and insurance payment for that property. So if you own 10 properties, you only need the 6 months in reserves for that property that you're looking to purchase. Mm-hmm. We can do those loans up to $2 million. I think that's the
What
basics.
About so when someone is doesn't fit within the box and they're looking at either commercial loans or DSCR loans, what is the difference in the interest rate and prepayment penalties for those loan products versus, say, your traditional 10% down second home loan?
Yeah, that's a good question. So they're typically, and that's where we've seen the biggest rate movement among all the products that we use in this space is the DSCR loans. So about this time last year, we were at about 10% as in the interest rate, not 10% down. And it's dropped over 2%. So right now, the margin between the 10% down second home occupancy loan and the DSCR loan is less than 1%. Mm-hmm. Most states, you're going to see a 3-year prepayment penalty. And then I'm glad you brought up the term commercial loan. So a lot of people think this is a commercial loan because you can do the loan in the name of your LLC. You can hold title in the name of the LLC. But the difference between a commercial loan and a residential DSCR loan, which is what we use, is that on a residential DSCR loan, you're going to be required to be a personal guarantor. A commercial loan, typically, that's going to be done in your business name. Your name isn't tied to it at all. That's typically not what you're going to see in this space. Now, if you're out on social media and you're seeing different information on DSCR loans, you're going to think that it is a commercial loan because they're going to say, it doesn't count against your debt to income ratio. It's not going to be reported on your credit. That is a big hot topic for me right now because that is completely false. And one thing that people need to know about DSCR originators is that you don't have to be licensed to originate a DSCR loan. So I'm a licensed loan officer registered with the federal government Any complaints made against me are going to be registered. You could go to a website, you're going to see those complaints. DSCR lenders don't have that accountability. So, it's almost like the wild, wild west. They don't have the same disclosure rules, and they will tell people what they want to hear. And one of those is that DSCR loans will not be reported to your credit. And on my podcast, I cover some of these things that you want to ask DSCR lenders. And if they're telling you it doesn't report, the next thing that you want to ask is, do you have that in writing? Am I going to be able to see that in writing? And if they say no, then that doesn't exist. It can be reported on your credit if it's not in writing.
That's a very valid point, Jeff. And I've heard for people who don't qualify for the 10% down second home loan, some of them use the traditional commercial loans, from local banks, or they end up using the DSCR product. And I know a lot of our members have gravitated towards the DSCR product because it tends to be a more advantageous product for most people. But the question I wanted to ask you, and this is an interesting one, is sometimes your CPA will tell you that, well, if you bonus depreciate a short-term rental, that's going to lower your debt to income ratio. So that's a tricky part. How does that factor into the calculation of the DTI? Because I know we talked about it actually adding to your income, after a year of having consistent income. So how does bonus depreciating your STR affect your ability to lend in the future?
Yeah, that's a great question. It does not. So it's a one-time event. So it does not come into the equation when we're calculating your income.
And so a lender should typically be able to add that back in before they calculate your income, correct? Because I think there's also different lenders approach it differently, and so some of our students have had challenges when they've bonus depreciated to then qualify in the next year for your traditional conventional mortgages. And so typically your lender should be adding that in. That should not be an issue. That's what I'm hearing.
Yeah, that's going to be a standard Fannie and Freddie policy. So we basically all play by the same rules when it comes to those conventional. So yeah, if you've got a lender that's telling you that bonus depreciation deduction that you took is hurting your income calculation, move on to the next lender.
Yeah, we've heard that from CPAs and from lenders, interestingly. So I thought it's a valid point to bring up. Awesome. There's so much more I want to talk with you, Jeff, but I wanted to, if you could shed some light as we're talking about, creative financing, alternate investment products. Can we talk about HELOCs and how people can tap into those to maybe for the down payment, or also specifically on HELOCs that people can take out on investment properties? Is that an option? What does that look like? So because I think it's the rules and regulations have shifted. I mean, the ability to do that has shifted a little bit during the pandemic, was my understanding. But if you could shed some light on that.
Yeah, I wouldn't say anything has changed a lot when it comes to the ability or the viability of that product. Now, I will say what it's available to do against has been drawn back. Mm-hmm. So being able to find a HELOC that you can put against an investment property is going to be a unicorn.
Yeah.
Being able to find one that you can do against a second home is going to be pretty rare as well. So really the most viable option is going to be against a primary residence. Now, I will say within the next 3 weeks, I should have a HELOC that we can use on investment properties. So I'm super excited about that because I love the strategy. I've got a podcast episode, I think episode 8 or so, on STR home financing, how to create your own down payment bank. I did a whole episode on some of the nuances of that, but I just like the idea of being able to separate that acquisition debt from what I would consider, or I call your personal debt on your primary residence. So your debt on your primary residence is typically paid back through like your W-2 income, or the income from your employment, whatever you do for a living. And this money that we took out in the HELOC to use towards down payment and closing costs to make the property rent ready is really business debt. And so that business asset should be paying back the debt. And it's a great way to separate it versus a cash out refinance where, you get this big lump sum of money. It's all, commingled together. The debt's commingled together. And then I just like the HELOC from the standpoint of the rinse and repeat aspect of it. And also the low liability aspect of it. So most HELOCs are going to be amortized over 30 years, the payment. And then, of course, you're only paying back what you draw. So if you've got a $300,000 line, you only need 50,000. You draw 50,000. Your payment's going to be 50,000 over 30 years, and then for the first 10 years, it's going to be an interest-only payment. So that helps a bit when you're trying to get a property off the ground, or you're trying to build bookings. You're keeping that liability low, but then the property pays it back. That first 10 years, you can rinse and repeat because you will continually be able to draw from that HELOC for the first 10 years. I don't recommend that you carry it out for the next 20 years, but you could if you wanted to.
Yeah, yeah. Great points. I want to, and you talked about ARMs in the beginning, Jeff, so I want to come back to that. There are people who currently do have loan products with ARMs and are probably considering buying, getting a new lending product that has an ARM. Knowing what to expect in the next few years, what would you recommend people do as far as ARMs? And I feel like every market cycle, every interest rate environment, the answer is different. So for people looking to invest now, what would you recommend if they currently have a product with an ARM on, or if they're looking to get a new lending product?
Yeah, I mean, my first question is what is your exit strategy from that ARM? And if it's, I don't know, it just kind of depends on what's going to be there when that 5 years comes. That's probably a bad answer. It's kind of that, well, I'll just let things happen to me as they come. I don't like to live that way. And I know a lot of other people don't as well. And it's hard to say what interest rates are going to do. So you just want to know what worst case scenario could be and what that would look like. So don't just, take it for face value that, at the end of the 5 years, I'll just refinance in something lower, because that's what I hear loan officers say. Well, you can just refinance.
Yeah.
Well,
yeah.
Can you guarantee me that? And I don't tell people that because I can't guarantee that there'll be a better option at that point. Now, the fixed rate environment, you know what you're going to get from day one. And with the rates that we have right now, yeah, more than likely over the next year, we're going to be able to capture a better opportunity. I feel confident about that, but I can't guarantee it.
Yeah, I like that. It's very similar to our approach. Also, even when we go into larger multifamily financing, we hear a lot of people saying, "Well, this is the time to get bridge debt because of the way the trend is." But we feel like take a variable out of the equation. It's a safer way because no one can guarantee that, and so we do go with fixed rate products. And so it sounds like we're on the same page, Jeff. Thank you for that. Final question as we let you go, and as we go into Q&A actually is, what do you see as the biggest opportunity for investors who are trying to get in at this point, like the next generation? What do you see happening in the next few years?
Oh, I love this question. And we experienced it about this time last year when Fannie Mae announced that you could buy multifamily with only 5% down. So, you're the parent of, adult kids or kids that are, about to graduate from college. You want to help them get in their real estate investment journey. You can be a non-occupying co-borrower on that loan. So maybe, they don't have a job yet. Maybe they're just going into college. You're going to buy something in that community. You can put 5% down on an up to 4-unit property, and and the loan amounts go up to $1,474,400. So 5% down on an asset at that level. That to me is a
amazing.
That's a huge opportunity, because we went from a as a primary resident, so they would have to live in it along with you being a
So this
non.
is similar to what they call a kiddie loan, right? Where people would take a loan out for a child who was in college. Does this apply to, I guess, is it to dependents or a child? What is the criteria to be able to tap into that?
No, I mean, and I use that as an example. So let's say they didn't have a job, they didn't have qualifying income, you would have to go on as a non-occupant co-borrower. And you're right, they used to have a family opportunity loan program
Yes.
where you could buy, a home in a town where your child was going to go to college. You only had to put down 5%. You got the same rates as a primary residence.
Mhm.
That aspect of the family opportunity loan went away probably about 3 or 4 years ago. Now they do still have it for elderly parents.
Got it.
So if you want to do that for an elderly parent, you could, but that would be a case, now the ideal scenario is that you're a young adult professional, got their first job and you provided this information to them and maybe
Yeah.
you gifted them the down payment or something like that and they qualified for the loan. Because the other thing is that they will look at, let's say you're buying a 4-unit property, they'll look at the rental income from each of those 3 units and you can use 70% of that towards qualifying. So they don't have to qualify for the $1.4 million loan. So to me, if you're talking about, uh, putting rocket fuel in your
Yes,
young
absolutely.
children's investment journey, this is it. If they could do 4 of those before
Yeah.
they're 30 years old, then
Then they're set. It's cruise control after that.
oh yeah, absolutely. And then they go back and 1031 that first one into a few different vacation properties. Maybe it just opens up this whole new world.
Yeah.
And to me, that 5% down on multifamily, that news that came out last year was the biggest thing that I had seen since the 10% down second home occupancy policy changes about 7 or 8 years ago.
Right.
When it came to investors. So I get excited about it.
Yes,
Sorry.
absolutely. So do I, when I hear about it. This is amazing. Thank you so much, Jeff. It's always, I learn so much when I speak to you, and I know you come from a place of education and serving, but also from, doing extensive research, and everything that you say is based on the guidelines that Fannie Mae Freddie Mac puts out. So we really, really appreciate all of that information.
Happy to help.
Yeah.
Thank you so much.
Thank you, Param.
Absolutely. Okay, this was an amazing discussion. I learned some new things, and I'm sure a lot of people did. Thank you again, Jeff. It's always a pleasure to have you on.
Oh, thanks for having me. Great to be here.
Okay, I'll let everyone get back to their evening. I will see everyone next week. Take care, guys.